Welcome back. Once again, the market story of the morning is the price of oil. Up this morning, crude oil is up 5% on Brent at 95.18, and crude oil is now up 6.25% at 89.10. But note that it is well below 100 right now at 89.10 on crude oil. The president told me yesterday that a deal will be signed tonight between the U.S. and Iran. And if it is not signed, then the U.S. will blow up every power plant and bridge in Iran. I spoke with the president yesterday morning on the phone. U.S. officials are expected to land in Pakistan tonight for a second round of talks, but there has been no official response from the Iranians on that meeting. Joining me now is S&P Global Vice Chairman and the Chairman of the CERAWeek Conference, Daniel Yergin. Dan, welcome back to the show. Give us your thoughts on where we stand right now in this conflict and the impact on the price of oil, Dan.
Yeah. Well, it's two steps back, what's happened. This has been a bad week for the Strait of Hormuz. 3 ships were fired on. 30 ships that tried to get through turned around and didn't get through. And, of course, the U.S. boarded that Iranian tanker outside the Gulf. So the Strait of Hormuz is closed. As you say, a lot depends upon negotiations, but the two countries seem far apart, and the U.S. objective remains to end the nuclear program. So I think we'll see. The president says an agreement this evening, but the pressure's there. And for Iran, it's a new power they had that they didn't have before, controlling the Strait of Hormuz.
Yeah, look at the price of oil since the U.S. put this blockade in place, Dan. You're talking about crude oil down 7.75%. You know, we had that huge sell-off on Friday. What's your take on prices today and where they have come from? I mean, the IEA is warning that it could take up to 2 years to restore energy output that was lost in the Middle East conflict, saying that the market could be underestimating the impact of a prolonged Strait of Hormuz closure. I think you got a sense of that when you spoke with all those CEOs at your CERAWeek conference a couple of weeks ago.
Yeah, their message was that the market is underpricing risk. What they're looking at is not the sort of day-to-day negotiations and so forth. They're looking at the physical reality of how do you move oil, where there's shortages. You look at Asia, where the shortages are getting worse. Simply people told stay home, work from home. Restaurants closed, factories closed. So Asia's feeling it the most because Asia was most dependent on the oil and gas coming out of the Strait of Hormuz. Europe is feeling it. And, Maria, where it's really starting to be felt is in jet fuel prices, which are way up globally. And there was one refinery in Kuwait that produced a very significant amount of the jet fuel for for Europe, actually. And you see flights. One airline in Asia has cut its flights by 35%. So that's something that you really got to keep your eye on. And I think that one of the things that we learned from this crisis, people focused on the Strait of Hormuz in terms of oil and gas. They didn't think about fertilizer. They didn't think about petrochemicals. They didn't think about helium. And it turned out that that area of the Gulf Arab states and Saudi Arabia are much more integrated into the global economy in a variety of ways than were recognized before this conflict.
Yeah, it's a great point. And Europe, we are told, could have just 6 weeks of jet fuel supplies if disruptions continue. Officials are warning that this could spread globally and hit developing economies before reaching Europe. But you make a great point in terms of the broader effect on helium and on fertilizer. And that takes you into other sectors like shipping and farming, et cetera.
And so, Maria, and one other that's very important, semiconductors, because helium is essential for the semiconductor production. And Taiwan, which is the king of semiconductor production, depends heavily on that helium from the Gulf.
It's a very good point. But, I mean, let's talk about when we get on the other side of this. Do you believe that a big sell-off in prices could happen quickly? Or do you think that's just optimistic thinking? Because, you know, the president says all the time, look, once we get out of this, you're going to see prices come way down. Just in a supply-demand situation, what's your sense of getting out of this and seeing a move in oil lower? How fast can that happen?
Well, I think the other day we saw that prices can go down pretty quickly. and I think will go down. I think there's probably a higher base floor than in the past. You know, before all this started in January, when the world was looking at an oversupply of oil, the price was around the low 60s. If this ends, you still have a lot of dislocation. You still have refineries not operating, so you have a much tighter market. So I think that prices would come down, but they would not go back to where they were in January, but at a higher level that would reflect the degree of dislocation that exists. I mean, you have facilities that have been damaged, and of course, 20% of world oil would come through the Strait of Hormuz. So if you don't have the capacity to use refineries or production, that will mean a tighter market and prices higher. But I think if there's good news breaks out tomorrow and a deal and people feel it's for real, then clearly prices will go down. The price, particularly the future price, is very, very keen to all the political currents, to the negotiation, which is different than the price that people may be paying for the next barrel of oil in Asia, where you have a higher price simply because they're struggling to actually find those barrels.
Well, meanwhile, should we be expecting a big quarter for the oil companies when they report earnings in a couple of weeks here? The top story in the Wall Street Journal this morning is that big oil is plowing billions of money into far-flung drilling sites to escape the Iran turmoil. The Journal writes that energy companies are accelerating searches for new oil and gas prospects outside of the Middle East amid war and high prices. ExxonMobil outlining a plan for up to $24 billion in Nigeria. Chevron expanded its footprint in Venezuela. Daniel, your thoughts?
Well, I think that's right. I think that what happened already is that there's a sense that our shale production is somehow going to get close to a limit in the next, it's fantastic growth, but it will flatten out. And so there's been a new interest in any event before this in exploration of countries finding new sources, going to Namibia in Africa or Suriname in Latin America. And I think this event does say that it's going to be the basic principle. People are going to want to diversify their portfolios. Of course, those exploration is one thing, but it takes 4, 5, or 6 years to then bring that production on. But I think one lesson of this is a more diversified supply of oil.
Yeah, but Dan, look at what the U.S. is doing right now. I mean, last week when I had the president on the show, he told me that the U.S. is producing more oil and gas than Saudi Arabia and Russia combined. He told that to the nation as well a couple of weeks ago. And he said you're seeing tankers now choose America and the Gulf of America. What are your thoughts on that in terms of the U.S.'s capacity?
Well, the U.S. has the capacity to produce, for instance, more jet fuel, and people are coming to the U.S. to get jet fuel. We can produce more oil. Certainly, the U.S. is absolutely the world's #1 producer of liquefied natural gas. And we saw at CERAWeek, we saw these European companies and countries were there to sign up new supplies, reliable supplies. So the U.S. is in a very, very different position than it was during previous oil crises. The one state that has problems is the state you were talking about at the beginning of the show, California, which is more integrated into the global market as a consumer than any other state in the country, and depends upon oil that is produced in Iraq and refined in South Korea and sent then to California, because California's policies has shut down refineries and has reduced production of oil in California by 2/3. So California stands out as, in a sense, the most vulnerable part of the United States to this global oil crisis.
That's incredible, Dan. And that's why Steve Hilton is leading, by the way. One of the reasons, all those regulations around gas and oil. Dan, always a pleasure to get your insights on this. Thanks so much for being here. Come back soon.
Thank you.
All right. We will see you soon. Daniel Yergin.